Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently roughly 5:30 p.m. Eastern, end of the North American trading session, Monday, July 10th. So, before we jump into our analysis, breaking down the fundamentals, technicals, sentiment, and translating that into trade ideas, I just want to go over some psychology reminders from our perspective as manual retail traders who are day trading and scalping these markets. So far, we can see the quarter has started off relatively mixed. We have a few examples of that, where in the example of the asset class such as gold, even though we've still been respecting this intraday bearish structure and seeing a correction from these highs, you can see from the end of last month into this new business quarter, we've been primarily in a secondary phase of market structure at these lows in a rough consolidation range from lows of around 1900 to highs about 1930s. It's very similar to the situation we were in here as well, or any other period, whether you're trending bullish or bearish, where you can get the secondary phases of market structure. Now, we can see also when we're looking at other asset classes, equities in the example of US 30, even though we're still getting that major exhaustion at 34,500 and that important liquidity zone we have highlighted on the higher time frame and reviewed time and time again, we're still not seeing major short selling in the market, or the market's really taking Fed's comments too seriously. Feds have still been pushing the narrative of rates being up higher for longer, but it just looks like the markets are generally focused and hoping for another declining inflation report so they can still try to keep markets in terms of equities at these higher price points. We can see that as even though we've had some hawkish Fed comments, very optimistic labor market data in the prior weeks, and the narrative holding more weight in the bonds market, we can see on the example of US 30, we're still failing to break this previous intraday low at around 33,700, creating a bit of an indecision here on the intraday as this downside move has been faded out. So it's not just on an asset class and commodity such as gold, it's also highlighted on some risk assets like US equities here. We can also see that indecision on currency such as dollar, where it was mixed to start out the week and of course led to being more bearish now, going down to 102. So it does look like we're going to be adapting to some continued dollar weakness, which can hold some weight all the way up until CPI. We still don't have much economic data in focus up until Wednesday, where US inflation figures are coming out, of course, during the North American trading session. And there's projections with the front loading of rate hikes that we're going to be getting closer to the baseline figure of 2%, with a CPI projection of 3.1% year over year. We're going to be talking about that more, obviously, as we get closer to that event. But for the time being, we can see from the end of the month into this new month, the indecision in intraday price movement on dollar. We can see Japanese yen in a secondary phase of market structure from these intraday lows to set up prices for the new quarter, where we anticipate this can at least still go to retest 71.8 and 72 price point. We can see a clear secondary phase of market structure on intraday timeframes on gold. We can see this indecision on US equities as well. So what does this mean in terms of leading into some psychology reminders? Well, we have to stay a lot more sharper and more patient as we adapt to these changing intraday price waves. We still want to stick to a singular bias, but in these types of situations, when you're not having your impulsive moves with trend or larger changes in asset price movement, right? In the example of gold not continuing further bearish and printing lows in bearish structure, we want to stay very adaptive to these conditions. And what that translates to us is potentially taking less trades, being more selective, adjusting risk and possibly risking less, looking to take only pre-planned setups but the setups are going to be at key price points at either the highs and lows, right? And it's going to be different from your aggression level and your execution when you're having clean cut trending markets. Because whenever you have a secondary phase of market structure, the price anatomy for us as manual retail traders, it's always a lot more choppy on these intraday timeframes. Even when it's a pullback phase, in the example, which we'll look at in a second, with how GJ has been so bullish on Japanese yen weakness, the bulls have been relatively solid, printing higher highs with minimal pullback phases. But this corrective phase has seen much more aggressive fluctuations in its intraday waves as we've been having the pullback from those new highs printed and from UJ at 145 as well. So when you understand the change in market waves of coming out of an impulsive phase and going more into a secondary phase, like a consolidation, you want to adapt to that accordingly, where you can clearly see you're not breaking highs or lows. You can clearly see you're not getting a clear directional bias. So we have to adjust to the markets. We can't let the market we can't have expectations of the market to adjust to us. That makes no logical sense at all. So this just means that until we get new fear, uncertainty, or doubt, in the example of gold here, until we have confirms for any new fear, uncertainty, or doubt, rising geopolitical tensions, markets having a reason to price in more future rate cuts or slower rate hike path, and breaks above 1932s, 1935s, I don't see any need to have aggression on the buyer side bias, right? And if this does take place and we're getting some bad economic data reports or within reactive headlines, maybe over an Asian or London session, getting some military tension escalations that are holding market weight, and alongside the technical break above this liquidity zone, which would validate a shift out of bearish structure, we can anticipate, as we had an accumulation phase here, having very large impulsive moves starting to trend all the way to the 1970s. This is where, as a day trader or a scalper, you want to be more aggressive. You want to risk a little bit more. You're going to be looking to maybe scale in entries or leave a runner risk-free. Scalping, you're going to be taking advantage of this move because then you have pretty clean-cut expectations of a range that you can take advantage of roughly 300 pips going back into the 1970s, right? Other than that, when you're in overall structure here, I still want to be sticking to the sell side, but even with the sells, if I notice I can get some great sells from range rejection highs or from 1925, taking advantage of some of the downside plays in this consolidation and still riding the trend of bearish structure is fine, but you don't really want to hold any positions. You don't really want to scale in any positions, and you don't want to really increase your risk and be more aggressive unless you're starting to break these lows, which gives you clear-cut indication of sellers still in control and more than likely another impulsive low being printed, which again could be $20, $30, $40 of movement in terms of per ounce on price change on gold spot here, right? So in the example of gold, which has some pretty clean understanding points here, we can obviously see this important liquidity zone at around 1932, 1935 that's been rejected. We can obviously see these last significant lows where we're starting to get some signs of exhaustion. We can clearly identify that we're in a secondary phase of market structure. And we want to adapt accordingly to that secondary phase of market structure because more times than not, a secondary phase of market structure, such as a pullback phase on the intraday or higher time frame, or an accumulation or consolidation, whatever you prefer to call it, right? When the markets are more moving sideways collecting orders, waiting for the next important fundamental catalyst. During these periods of times, for us as manual retail traders, it's simply more choppy conditions, right? Aggressive, lower time frame price waves, pullbacks within the range, sporadic movement versus impulsive, right? So what does adapt accordingly mean to that, right? Doesn't mean you just know it exists and then, okay, I know these conditions are choppy. It means we actually change some of the normal decisions we would make in impulsive markets, or when you're just having continued movements with trend, or when you're having a break of structure validated by a fundamental reason, right? So in this example, it would be taking less trades, more focus on preserving capital, increased patience, decreased expectations of overall market. Like within this range, if you take sales from the top, you should have expectations that you may come to the bottom of the range, but you shouldn't be praying that because you're in a sell finally, that we're going to drop to 1870 for no reason, right? You should decrease your expectation. Right? Versus in this example here, if you just get continuations of structure, you want to adapt accordingly by being more aggressive, increasing risk accordingly, potentially looking to scale in positions or let positions ride, set risk-free runners, and so forth, right? Or the last example where you want to be very similar to this is a change in structure move. So in the example of gold here, in the example of gold here, that would be if you get any new fear, uncertainty, or doubt, bad data, break above 1932s, 1935s, and you'd expect pretty clean cut with the failure to break these lows, the accumulation, the breakout of structure. The breakout of structure at that time, a pretty clean cut range to identify of digging into the 1970s, not instantaneously, might not be a singular hourly candle, but over the next period of hours and sessions, right? If you get those confirms, that's also a period of time where you want to be more aggressive, potentially increase your risk, calculated and accordingly, look to scale in positions or hold trades longer and get an increased risk versus reward and so forth. So the main reminder at the start of this market analysis and trade ideas, this is the psychology, but the psychological information can only be adapted to and understood if you know what's going on in the markets. So right now, you can see There's periods of times where you should be taking less trades, focused on preserving capital, increasing your patience, decreasing your expectations, being less aggressive, lowering your risk, and focusing more on studying, backtesting, and learning. And then there's periods of times where you should be hitting the gas and accelerating and being more aggressive, because we have to stay adaptive to the markets. This isn't like a job where you're getting a set paycheck for every day you show up. We want to take advantage of certain market movements and stay out of other certain market conditions where majority of people are just going to waste capital, over trade, and lose their money in those conditions anyways, right? Most people, they're not losing money unless you're a retard when gold's trending down and having impulsive movements. If you know gold's bearish and you're taking advantage of sells, it's very difficult to overall be net losing when you're having these impulsive moves down as a day trader or scalper. Most people are losing money in these situations where you have secondary phases of market structure, aggressive pullbacks or consolidations that can last days, weeks, sometimes even months. I remember 2018 or 2019, GJ in like a 50 pip range between PPLs on the higher time frame for almost the entire month of November, almost into the end of the year period as well. And we just had to stay adaptive to those conditions. We weren't breaking significant highs. We weren't breaking significant lows, but people who did not understand that, they lost more money than ever just being caught in a GJ range. And then that vicious cycle ensues where you take a loss in the range, your stress levels increase, your emotions increase, increased probability you're going to follow up with another poor decision. And that's when the avalanche and rock slide of you're destroying your account really comes in, right? The reason why I want to talk about this is there's a high probability that gold or a lot of these other asset classes may see this indecision all the way up until inflation data midweek, maybe even after inflation if it's a dud and not really showing that much significant change, still just between the forecast and between the prior. Does that make sense to everybody? That little psychology reminder. So this isn't just like on something like gold. For the example on US 30, when we're just looking at the intraday here, I took shorts here and I'm in those sells, but I'm starting to lose confidence in those sells if we start to correct and not hold below this 34K price point, because overall on the intraday, we can clearly see this general range we have been since not just July, but the start of June, right? I would have way more confidence. I would have way more confidence in holding these shorts if we were trading below here or scaling in or looking for further positions or expecting this move to be corrected. You know what I mean? Bro, I'm trying to talk about something important. You're asking about something useless. Man's asking about bricks, bro. Bricks can suck my dick. Brick can suck my dick. It's not doing anything. Brick's been around for a decade, man, since 2013. You're getting lost in the media noise instead of focusing on key concepts to know what's actually going on in the markets and driving market price. Bricks are just media distractions. Don't get lost in the media noise, bro. We've already talked about this so many times too, just to remind people, don't get lost in the media noise. Or you can see this example with like GJ, right? So you can see GJ here clearly failed to break these highs around 184. Same time, we're of course starting the new business quarter, and Japanese yen individually, when we're monitoring JIXY there, JXY index, doing a pullback from these new intraday lows, right? Now, overall, it's been very bullish, but you can see as we're entering this secondary phase of market structure, ever since you had the first signs of exhaustion from these highs, the downside has been very, very choppy, right? You can see, you can take advantage of these pullbacks, but if you're not getting good entries, some of these aggressive pullbacks, some of these aggressive intraday price wave changes, which is very common in pullback structure, is going to bring you a lot of annoyance and stress if it comes into your entry or goes into your stop loss, if you're trying to catch some of these sells in a pullback play late, right? So the price anatomy between bullish and bearish structure, it's always more night and day different. And it's obviously a lot easier to just be playing with the trend, but you're not always just going to be trending from our perspective of a manual retail trader. As you're overall running a macro directional bias, like in the example of UJ here, more bullish on a macro rate differential of higher interest rates and tightening conditions by the Federal Reserve, but ultra loose financial conditions and keeping interest rates in the negative by Bank of Japan, clearly UJ is very bullish, right? But we're not investing into UJ or looking to positional trade it. We're day trading it, scalping it, and so forth. And you can see some of these pullback phases can last weeks when you're looking at the timeline down below, multiple days. And it's not always going to be a pullback phase as your secondary phase of market structure. Sometimes it can just be an accumulation, right? But the key thing to understand is the price anatomy of these secondary phases of market structure. Sometimes it can be impulsive, but it's still going to be accumulating orders, retesting key demand zones for an extended period of time. And the timeline of these secondary phases of market structure, how they can last weeks, sometimes months, days. So clearly, if you're scalping or you're day trading, when you can identify that you're in a secondary phase of market structure, we want to adapt to that accordingly. So in the example of UJ here, which is still very macro bullish, as a day trader or scalper, you want to make the decision of either you're going to completely stay out of this downside move, or you're going to day trade this downside effectively. Understand that the price waves can get very choppy and it cannot be as clean as when you're having just impulsive moves with trend, potentially leading to better buy areas before continuing more bullish. Right? So you can see most asset classes are in a secondary phase of market structure right now. Gold's in accumulation or consolidation at these intraday lows, roughly 1900s. Equities are pretty much hugging in the example of US 30 from 33,700 to 34,400. We can see GJ in a secondary phase of market structure, which is more of a pullback phase from these highs. UJ in a secondary phase of market structure, which is a pullback from these highs. The only other thing is on the intraday, we want to take advantage of dollar weakness, where it looks like dollar can be heading down deeper into the ranges here from 101.5 and so forth, as we still don't have too much fundamental support in the near term for US dollar bulls, as clearly the markets faded out those hawkish comments from Fed speakers and didn't see it as bringing anything new to the table. And inflation data still isn't until Wednesday, where inflation is still projected to be decreasing and can still hit those targets of 3%. Now, as inflation drops back to baseline numbers, back into 2% and so forth, and the targets get hit, the issue isn't just hitting the target, it's maintaining there. And maintaining inflation at 2% is a lot more of a difficult and harder job than bringing it down to 2%. Where we're going to start to get the fluctuations of CPI reports and start to see some CPI reports edging to the upside, in my opinion, is the next few reports to come. Possibly this one could still be trending lower, could still be going towards the goals. And I think the next couple may be starting to show signs of fluctuation as you're getting close to historical baselines. And that's where the struggle really comes to maintain those figures, right? So with dollar weakness and us potentially breaking below 102 price point here in the intraday, that would give us cleaner cut buys if we can remain above these highs with our adapted buy area of above 1.28. And also Euro USD breaking above this rejection point, heading up into 1.08. This looks more applicable so far up until inflation data. For us to look for any reversals on GU and Euro USD, we would need to see dollar bouncing from 102, rejecting here again, and we would need to see GBP USD canceling out this upside move and coming back below 275. And also we would need to see Euro USD coming back below 1.096. Otherwise, on dollar pairs, we do want to remain objective and adaptive to what is going on in front of us. And to start this quarter, dollar has turned more bearish. Fed comments didn't hold too much weight to bring back demand in the dollar. Equities are still seeing the greed holding, with US 30 rejecting 33,700 area there. And volatility index is still relatively flatline, with global equities still trying to hold and squeeze out some of that greed. So unless we get dollar bouncing off 102 and these upside moves getting canceled out, we're going to be adapting to that short-term dollar weakness bias. Now, in terms of economic events, not much going on besides some UK labor market reporting overnight, which is the United Kingdom's equivalent for their section of reports compared to US like NFP, unemployment rate, and wages data. Through the, actually, this is a tentative approximate release time anywhere between here. So not much going on through the Asian session. And then through the London and Euro session, some inflation figures from Germany, which are still expected to be relatively stagnant, not showing major signs of deflation just yet. And that's getting released at pre-London hours. Also important data at pre-London hours, 2 a.m. Eastern, is your UK labor market. Unemployment rate is expected to be the same. Employment change is expected to show a bit of a decline. Payrolls change and claim out unemployment account here. That poll is the same as prior. We could for sure see some rebounding from Bank of England's comments that the labor market's still tight, and especially from these very low figures here. So we could still see the UK labor market remaining relatively tight, especially as they were a bit, just slightly a bit behind the curve compared to the Feds on aggressively front-loading rate hikes there. Now, if that labor market is still tight, in my opinion, that can bring GBP strength as it's optimistic data for the UK, but also shows that the Bank of England will continue their path of tightening financial conditions and focusing on bringing inflation down. So that could, if this data is good, potentially give GJ an aggressive bounce and GU to continue higher on dollar weakness as well above those highs. Otherwise, nothing really going on through the North American trading session tomorrow. We do have a couple of Fed speakers, actually just one at 11 a.m. Eastern, London session close, John Williams. More than likely, with what we've seen with the collection of Fed speakers today, his comments won't hold that much weight unless he's really bringing something new to the table. So with a lack of fundamental events, no reactive events, geopolitical is relatively quiet, market focus on inflation data midweek, it does look like we're going to remain in the secondary phase of market structure. Gold's macro case for bulls is obviously increasing, and we've been discussing how on the weekly here, we're either going to see buyers come back into the scene if we can cleanly come back above the 1940s, but if we can't do that, seeing a larger correction on gold into the 1800s for buyers to jump in from lower demanded price points wouldn't be out of the ordinary. So it'd still make the most sense of seeing buys above the 1940s with fundamental catalysts to support that. Otherwise, this bearish corrective phase can still be holding the most weight, creeping into the 1840s and 1820s. The important price points I'm looking at here are that liquidity zone roughly at 1935, 1940s. These lows on the intraday at 1900s. Key price point around 1810s. And the last considerable highs into the 2000s. Same idea where clean-cut buys, bad economic data, new fear, uncertainty, or doubt, markets pricing in, rate cuts, and breaks above 1940s. If we don't get that, then we can still see some plays like this before buyers really come back into the market. Overall, psychology-wise, we want to stay adaptive to these conditions as we're still in a consolidation. So for our main bias, we're still going to be respecting the bears. Very common for gold to be rejecting and retesting liquidity zones multiple times, still holding and trading below the 1930s, still respecting bearish structure, still a pullback from these lows being printed here, and haven't broken structure yet. This gives us very clean-cut information where we would get safe buys if we actually now hold and trade above 1932, 1935. Especially with the fundamental confirmations I'm talking about. Otherwise, if we still fail to break this area, still see the same sell plays from previous market update webinar. Rejections 1929 key level below the liquidity zone, scaling below 1925, safer below 1912. Main bias, secondary adapted bias, understanding current structure, secondary phase of market structure, and so forth. Now, GJ may potentially see a bounce if we get some optimistic data, but from current price points, we could easily still dig into deeper pullbacks into 180s. Otherwise, safer buys would really be coming back above 182 with optimistic data. Otherwise, I'm expecting something like this still. So in terms of translating that information into trade ideas, if we break below these lows, I would see continued pullback plays and short-term sells to retest higher time frame structure and next buyer liquidity zone of interest into roughly 180 flat price point, 180.2, scaling the sells down more than likely into this area, watching here as well. Otherwise, for us to be jumping just back into the bullish bias, I would want to be canceling out this downside move and trading back above 182 and 182.2, watching price points and reactions around 183.2. This just straight bullish bias would be further supported if UK labor market data overnight is still more on the optimistic side, showing signs of rebounding, following the signals from the Bank of England representatives, and still further supporting the narrative of the Bank of England continuing to tighten financial conditions and focus on the fight on inflation, which brings some more demand into the British pound currency. With UJ, we can easily be retesting and still see some sell plays if we remain below here at 141.5 and 140.8. This is just a subjective trend line, but more than likely we'd be coming all the way back down to like 139 flat before seeing further buy bounces into the market. Otherwise, I only see us jumping back into buys if we can break above key level 142.5. More than likely, that may not happen unless we get CPI data that's still showing increase or not meeting the optimistic projections, And that would be a catalyst this week for demand to come back into the dollar. Otherwise, dollar breaking below 102, the same time and having that intraday weakness, the same time yen still has expectations to pull back to this liquidity zone in the first area of interest around 71.8 and 72 price point, correlates pretty nicely on UJ, still having some downside plays to retest this last liquidity zone of interest here after breaking below this area at pretty much 139 flat. So short-term sell plays, if we still have dollar below 102, yen in a pullback phase, holding below this gray zone and key level, more than like, don't worry about the subjective trend line. Structure and liquidity zones are validated by price points. We'd be digging into there before seeing any buyers come into the market. Otherwise, to just jump back into buys, we'd have to be breaking above 142.3. Still in macro bullish structure, fundamentals bullish, just that secondary phase of market structure, which we predicted if we couldn't break above 145 and started to trade below 144. We anticipated our first area of interest would be 142.3 key level, where we had a short-lived bounce, but with dollar weakness today faded that out. So we want to remain adaptive as this pullback phase is extending deeper. Dollar weakness is leading nicely into our adaptation points on GBP USD and Euro USD. Especially with expectations that UK labor market data can still be potentially more to the optimistic side, and we still have that dollar softness. I could only jump back into GU sells if we're going to revisit higher price points of interest, roughly going into 1.3 flat, or for us to jump back and expect any type of reversal, we would need dollar bouncing above 102 or very bad UK economic data, this upside move getting canceled out and breaking below 275. Euro USD also looking like it has potential now with the stronger bullish sequence of events and break above these rejection points, where if we break above here, there's targets up into 1.06, especially that can be supported in terms of intermarket correlations if dollar breaks below 102. The only thing you have to be cautious about is, of course, CPI data on the Wednesday. Not much Euro data in focus. If anything, if German inflation data is still elevated, just shows that ECB still needs to keep financial conditions tight and do some more rate hikes, which can bring some short-term demand into Euro, especially against the current weaker dollar. But if it trades and holds below 102 there, difficult for me to see sells unless we're breaking back below 1.095 or 1.093. Otherwise, looking for these pullback buys or breakout buys, clearing this last high price point, possibly just retesting this high here and then above key level, playing dollar weakness. For us to even think about sells again or any reversals, we'd have to have the same correlation confirms and canceling out that move, and it'd still be some nice legs to the downside if it does take place. But so far, at least until Wednesday, we still want to adapt to this current dollar weakness. USD CAD still just ranging here, not really seeing any major price change. Pretty similar trade ideas. Sells below 1.323. Buys above 1.331. And if we break above 1.338, just continuing still the trend, even dollar breaking below 102 and starting to be more bearish on the intraday, didn't hold much weight on USD CAD at all, as the Canadian dollar still relatively flat there. We also do have Bank of Canada rate decision. So they're expected to do a rate hike if they just do the expected rate hike, then it can lead to a buy the rumor, sell the news play, and actually some short-term Canadian dollar weakness if they don't bring anything new to the table, and it's just the expected forecasted play there. Last but not least is a US 30. I would only see safer still buys on US 30 with clean breaks above that higher time frame liquidity zone at 34,500. Otherwise, if we just sweep up and still hold below 34K, 33.8, and the safest sells below 33.5. It does look like stock markets are going to remain relatively messy, even with inflation report on Wednesday. We might not see any clear directional bias. It would be ideal for the shorts to see some more strength in the volatility index and us trading below 33,600. Okay. Does US 30 look like a double top? Brother, US 30 at 34,500 is more than a double top. It is a 10 top. Let's count. Ready? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 top. So that's why I'm saying, like, even though there's a lot of evident greed in the stock market, in the example of the index US 30, it's very difficult to me to assess that there's a new bull market or buyers are in control unless we're trading above there. Trading above there is very clean cut buys riding up to 36K on the delusion of future rate cuts to come and the market's continuing their forward-looking greedy crackheads with capital approach, right? Other than that, we've adapted to some rallies up to this price point, but overall, more than likely looked for high risk, high reward shorts from here. Now, your shorts have to be from this entry point and pretty precise, and it takes a lot of patience to even take advantage of some type of move. In this example, it would have been ideal trading below 33,600. But for the entirety of 2023, US 30 has been in this rough higher time frame range, pretty much from those 34,500 highs to 32,500 lows, roughly there. So markets have just been coping, not wanting to price in the rate hikes, not wanting to let go any gains, trying to let as much time go by and hope nothing breaks and Feds start to give signals towards rate cuts so they can continue to rally. But I don't want to take any clean buys unless we're breaking above 34,500, which is a very clean intraday range and higher time frame play to like 35,500. But anyways, nice little webinar and refresher here, psychology refresher, and good understanding of the different phases of market structure and how we should adapt as manual retail traders. Understanding of what events we have in focus, more of the data in the second half of the week, current market conditions, analysis, and trade ideas across the board. I will see you guys in the morning for our routine New York scalping session.